Okay, hi, good afternoon, everybody. Thank you very much for coming back. Thanks for joining us this afternoon. Happy to move into a session today on the subject of technology investing. So we'll start off with a panel, technology investments tapping into a growing sector. And then this will be followed by a presentation by Benson Tam, chairman of Venturus Group. So I'll hand it over to our moderator today. Our moderator is Edmund Yong. Edmund is managing partner at Accel X in Singapore. Edmund, I'll hand it over to you.
Hi, good afternoon. Basically, I run a very early stage fund, and in doing this for the last 10 years. My background is a lot of operation, running logistics company, medical, and also in the mobile space. Now currently, basically, still looking for good deals. And today's discussion, I think we're looking at technology spaces that could be interest of family offices. And we have a interesting panel of people who actually invest in early stage as well as in fund of funds and in really interesting deals. So I'll start off with Alex, who can introduce, with Mikhail. Maybe each of you will actually introduce yourself in turn. Mikhail, we're gonna start first, and then can Benson take a second spot, and then Chem.
Sure. Yes.
Mikhail?
So, hi, this is Michael. I live in Singapore and had the pleasure of doing so for 10 years. Stay here with my wife and son. So what I do is I run a VC called Investigate and invest in what sets us a little bit apart. We invest quite early stage. We believe that gives best return on investment, and we also have we are industry agnostic. We concentrate on a certain business model called network orchestrator business model, which have, so we're looking for network effects in the companies we are investing in. We have a portfolio of 12 companies as of today.
Thank you, Michael. Benson?
Well, hi, everyone. I'm Benson, and one sentence to describe myself: I'm lucky enough to have invested in the first round of Alibaba in 1999. That's 21 years ago. And we are still in there. I haven't sold a single share. And for the last 8 years, I've been doing venture capital and private equity, primarily in China. I've been living in Beijing for the last 18 years. Today, I have set up a Venturus Group, which is basically set up to invest into technology to make cities smart. So we'll talk about it later on, and today, and let's focus on the technology opportunities in Asia. So, Edmund.
Yeah, thank you. Maybe I'll just briefly touch on Chem. Thank you for joining us. Maybe you could give us a quick introduction of yourself.
Yeah, of course. I'm Chem, CEO of Ferret Capital, a single family office based out of Hong Kong and San Francisco. We a multi-strat fund of fund strategy looking to deploy into alternative funds, focusing on a range of vehicles from hedge funds, buyout, growth, credits, and venture, with a bent, probably with a bent toward venture. Give me a background. I also double head as a GP of Creative Ventures, which is a deep tech venture fund based off San Francisco, investing in companies with advanced technologies, solving problems that are long lasting.
Okay, maybe I start off the panel discussion by asking each of the panelists, if let's say each of you have $5 million today, what would you invest in? Michael?
So I would actually continue doing what I'm doing now. So looking for startups here in Southeast Asia. I think this is a region which have great potential, great growth, especially in the digital spending. And it's also a little bit away from the hotspots, China, Silicon Valley, and maybe also Europe. And and also what what we are investing in, these network effects. I think it's the most opportune time to invest in startups, because you have these, the AI and big data analysis is more available than any time before. You can be up and running in 2 minutes, complements of AWS and Google Cloud, etc. So the ability to disrupt industries is greater today than ever before. So I would stay in this space. $5 million, yeah.
Right, Benson. I know you run a $1 billion fund. So what would you do with 5 million, which is probably a bit small for you, but what would you do?
Well, let's call it 5 million from a typical family office. I would say
Right.
The answer is easy: technology. Because the way that I look at the whole world right now in terms of economy, there's only two parts. There's only two sectors: the traditional and the technology side. Technology, you're talking about 10% growth a year. Technology, traditional, you're talking about 10% growth. Technology, you're talking about 100. So it's easy. So focus on technology. So how do you go there? There's a simple way. Go for the best. Ali, Tencent, even Ant. Those are easy ways. Those are the technology blue chips. And I actually think that they are not bad at all, because, for example, like I said, I've been in Ali for 21 years. The reason why I'm still not out is it's so liquid. It's almost cash, except that this cash grows at 25% a year. And you're not taking tech risk. This is digital infrastructure. So effectively, it is infrastructure-like exposure, 25% growth, and yet it's like cash. So that's why over the last 10 years, actually, my own personal portfolio, from 10 stocks, it's been whittled down to just one. So I would just say that if you want a no-brainer, then something like that. If you want something a little bit more adventurous, then yes, I would say, as I will be saying later on, I think the overall umbrella right now, the opportunity is this whole smart city internet technology. And we'll talk about that. But you can do it through funds, you can do it through fund of funds, you can do it through GPs, but there are many ways to do that. But there's a simple way and a difficult way.
Sham, what do you think?
Yeah, so it depends a little bit on what the objective is, but definitely agree with Benson. So for my personal portfolio, basically it's all on the alpha side, it's all tech, and that's where the only growth opportunity really is. If you look at the whole S&P and CSI, there isn't really other rooms, which is a bit of a shame in a sense, because would probably want to diversify a little bit more. So if you want to have a bit more liquidity, certainly blue chip listed stocks. I think that for NASDAQ over the past 3 years, it's returned several multiples over time, and probably will continue to do so, especially given the pandemics. Zoom has been up something around 30x or something. It's been really crazy, right? So a lot of these companies will continue to do well. For us, we focus a lot on secular trends, especially being early stage investors that are going to last throughout the next decades or two, primarily on labor automation and rising healthcare costs. If you look at the trends, Amazon, it's way more and more cases of COVID contractions. And this is not enough people to fill out a fulfillment center. So that's one area that we look a lot deeply into in terms of automating warehouses. Healthcare costs is another areas where we look to find companies that do early diagnostics of chronic conditions. So that's what pretty much go-to places.
Okay. I personally also, all my portfolio is technology, so I totally agree with Benson, and I think technology is the way to go. I think for the audience, I think maybe we can actually basically think about the verticals that with technology in it that actually can be potentially be looked at to invest, maybe anything from 5 up to 100 million. It depends on the size of the family office funds available. Maybe Michael, what do you think of a particular? Maybe give us a key example of a vertical that you think that is absolutely necessary to actually look at now and for the future.
So I think that you have to be aware of how disruptive technology is. So if you're holding assets that are probably more mature assets, maybe in more traditional industries, these industries will be affected even more going forward than they have in the past. So, for example, if you take Fortune 500 companies, the average lifespan of a Fortune 500 company was more than 50 years back in the 60s. Now the average lifespan is 12 years, around there. And that means there's so much happening, so much change that disrupts, that you have to dip your toes into this tech, and especially tech startups, in my view, because the ability to disrupt industries have never been greater before. So if you don't have some exposure there, I think it can be dangerous also for your current assets, that you don't have an understanding of what's happening and how quick it's happening. So for those reasons, I think it's very important with a certain exposure to the tech startup world to have a certain understanding of what's happening, what changes, and how does that affect me and my rest of my portfolio.
So what would you suggest as potentially 3 verticals that we should probably be looking at in the future? Alex, Michael, sorry.
Yeah, so actually, so I think there's a lot of verticals that got a great boost out of the COVID-19 situation, and I think as I think Benson mentioned, e-commerce or fintech is a great space. But again, a lot of these tech startups, they also jump verticals. So if you are an early stage investor, I think it's quite good to be sector agnostic, because let's say you're a fintech investor, you would not have invested in Grab early days. But who is one of the biggest fintech players in Southeast Asia today? That's Grab. So if you're going to be a very early stage investor, then I think you need to look more at the network orchestrator business model or the network effects to choose the right winners, and they will probably jump several verticals in their growth to success. So, but of course, especially with COVID in mind, online collaborative tools and video conferences, gaming, online entertainment. Also, I think the gig economy will get a boost out of this. This is maybe another sector which is a little bit forgotten here. But also healthcare, I think, will get a long-lasting boost out of this. So health tech is also another thing to keep in mind, in addition to this fintech, digital banking, e-payment, and so on.
Great. Benson, I know you're a fan of Ant, and you have made a lot of strides with Alibaba and whatever. So give us your views on maybe the 3 must-have sectors that maybe the audience could be interested in.
Yeah, absolutely, Edmund. Again, assuming that it's family offices listening in, I'd say the easiest of my 3 vertical is fintech. It's well understood. It is possible for people to understand. You do have Ant to think about. It can be others. I'm not saying Ant is the only one. I'm just using that as an example, but fintech, because I think that is the most ripe, and in terms of the size of the market and how it will impact everything, fintech is the easiest in the 3 vertical I'm going to talk about. Now, the next vertical is what I call the smart city technology. I'll be talking a lot more later on. It is not well understood. It's only in the last year or so that some of the major banks have caught on to this vertical. But I think that is also another huge one. The third one is actually, like Mikhail was saying, medical technology. But within medical technology, I would say for the typical family office, don't do it yourself. It's very, very difficult. It is very, very technical. So that one, probably go for a GP that knows the stuff. And even the GPs, there are very few that truly understand it. And if the GPs, I would typically say in medical technology, find the GPs who actually are doctors, who actually understand, not just another investment banker. So those are the three verticals: easy, emerging, difficult. But I think all three are going to be, like Mikhail was saying, for example, fintech, blockchain will change everything. So watch what digital currency in China is doing. Meanwhile, Ant has launched their own flavor of blockchain called Ant Chain. Again, what is the impact of that? Do try to understand that.
Great, thank you, Vincent. Chem, I know you briefly touched on healthcare as well, and you are an early stage investor. So what does your crystal ball tell you in the next 10 years?
I wish I do have a crystal ball. If only, right?
We all try.
Right. So first, as early stage investors, we look for significant tailwind that coming out of different global macro trends, particularly changes in legislations and working behaviors as a result of COVID. So that's has been what I've been focusing on over the past 6 months. On the medical part, we've done quite a lot of research into it. There's actually a new legislation passed by the CMS on a breakthrough device designation that basically, just long story short, accelerate a lot of the pathway for medical device that are deemed breakthrough and the certain definitions that goes into that. So we definitely look for a medical device that get a tailwind coming out of those legislations, and those are bit more specific. One thing that we also see, and I think that a lot of people have talked about supply chain fragility across the world and the reliance on China, particularly on the bio side. So a lot of the APIs in the actually manufactured in India and in China, and a lot of infrastructures for drug makings are imported from there. We see that there's actually going to be quite a bit of a needs for the US to move a lot of drug making facilities back to the US. And that's going to be a breeding ground, a lot of a tailwind for those who are interested in new bioprocesses for drug makings, specifically utilizing synthetic biology, which has been up until this moment sort of a bust through Beyond Meats and all the alternative proteins. So the next stage, apply that for drug manufacturing and making it possible to bring the infrastructure back without investing billions into it. And I think that's only going to intensify no matter how the US election goes as a result of the supply chain fragility that COVID exposed. The last one is the one I really like, is to look at the underlying automation technologies that cut across different industries, particularly as it stems from the need for e-commerce and teleoperations. So pick and pack sorting automation for fulfillment center is obviously very important. All e-commerce companies struggles to fulfill the orders, and it's just not going to be enough people to hire efficiently to fulfill all of these things. So even if they could, it's just going to be very not cost effective to do that. So we do look for some of those robotics technologies, as well as teleoperations and remote work technologies that will enable the post-COVID working environment.
I personally favor 3 areas. One, I think most of us are actually looking at healthcare, but more healthcare in terms of, because of the aging population down the road, I'm looking at technology that cuts across ability to provide services as well as technology to the elderly. And I think the elderly population in the next 20 years is going to be huge. And frankly, I don't see any government solving that problem at the moment. And currently, a lot of investments have gone into the housing as physical asset rather than the tech. I think technology could do a lot for the elderly as well. That's one. Number two, I think I like e-education, which is actually basically looking at the current situation and in the future, how things can actually be better for the future children and the future of the world, right? E-education. And then finally, I think logistics, as I think Chem and Vincent will talk about it. And I think it cuts across various industries and how it can facilitate whether it's going to be e-commerce or even the physical backdraft of channeling of manufacturing back to the rest of the world versus China. So that is going to be something that is quite interesting. Maybe, yeah.
If I may just have,
sure,
so it's interesting because I'm also supply chain technology or logistical tech is quite interesting, and but fintech can also influence decisions there. So we invested in a company called Portcast, which is a supply chain technology company. So they're doing volume predictions of cargo and so demand volume. And they're doing that by taking the proprietary data from the customers, FedEx, ONE, etc. So both maritime and air cargo, and combining that with 22,000 data signals out there, a lot of the economic data, calendar data, etc. And my interest in investing in that, the first business model or the revenue model here is, and the value proposition is quite good, but the reason I invested was the data they're getting out of this. So this will become a fintech company, and they're already seeing that. They can predict, there are assets listed in the public market that are not priced correctly because they have an insight in what's happening in the economy going down the line. So fintech has a tremendous play in a lot of different industries.
Okay, I think maybe on top of mine, and I think other than appears that other than China, the rest of the world is still suffering from this pandemic. So assuming that if you look at the stock market, I think everybody assumes that everything will be over within the next 1 year. So in a what if scenario, if let's say this pandemic lasts for the next 5 years, what do you think? How do you think your investment decision will change in the next 12 months? Why don't you start with Chem?
Yeah, I mean, I think we'll reach herd immunity first. But let's say the virus mutates and so on and so forth. I think people will always find ways to adapt. Deals will start to have to be done without seeing people face to face. I think that in the States, VCs are very notorious to having to meet with people before they make the investments. We have never required that. So that has been little change to what we do. We've kind of done things fairly remotely. But I think that the new normal will become normal within the next 12 months or so. So if things were to be like this for the next 5 years, whatever opportunities that are squeezed, we can basically write them off, say like travel, tourism, XYZ, right? Those will be gone. If anything, it will give us more comfort to know that this isn't gonna be short-lived. Because some of the concerns, especially when we deploy into early stages, all right, there's going to be tailwind, but how long would this tailwind last? When by the time the company sort of grows up enough, would the tailwind still exist? If it actually exists for 5 years, in a way, it's even better. If we're looking to deploy into more of a COVID-driven type of trends or companies. So I'm not as worried about that. What I'm more worried about if things kind of keep changing. Say this year's is pandemics, next year's something else, and so on and so forth. When the environment changed very rapidly, let's say like there's a US-China war, then everything would all the playing field would be rewritten, and I'll be more worried about that.
Benson, what do you think? If let's say the pandemic lasts the next 5 years, would your investment decision totally modify or will still stay at what you think is best?
Well, actually, that's a very good question, Admin, because, and I'll be honest, I have no answer to that. I don't think anybody has any answers to that. I mean, it's just, if you look at where we are now and compared to a year ago, who would have imagined, correct? So 5 years is several lifetimes. So the reason why I say that is that there's going to be a lot more black swans, there's a lot more chaos, there's a lot more uncertainties. So, but that's how I've invested in the internet for many, many years, which is that internet and all of that basically create a lot more uncertainty. And what I seek is something that is rock steady. And that's why I think that's why we're all here, which is that COVID or no COVID, travel or no travel, it's going to be technology, right? Unless you tell me that you're not going to eat and you're not going to do investment, you're going to do something. In fact, in my speech, I'm going to say no travel equals all digital, correct? That's why we are digitally meeting today. No travel equals all digital. So one thing clearly it will happen is that tech will become mainstream, you know, and that's the certainty. And that's why I focus on that and leave the uncertainty. I can't deal with the uncertainty. So I just focus on, I call it, it's like in a rapidly flowing chaotic stream, like you are white rafting down the river. There's always this swirl that is almost very stable because of the rock formation around it. And so I'm looking for those very stable swirls. And I think technology absolutely is one of them. And other than that, you know, we'll see, right? Isn't it? Yeah, and I think if you accept that, then suddenly it's much more clearer. I think the problem with a lot of investors is they try to take out the crystal ball to see what is impossible to see. Something else that I think is very, very certain as well is I think this low interest or zero interest environment will be with us at another 5 to 10 years, especially with COVID, it will be even more. Now, that is another certainty. What does that mean? That means that I think governments everywhere will be under stress. Governments everywhere will be printing money. Effectively, there is a huge asset inflation. That's why I say that it means that we need to invest more, not less. A lot of people try to invest less. I think it's wrong. I think asset inflation is going to go sky high. And the haves will have more, the have not will have less. And if you invest less now and be prudent, you actually will fall behind.
Yeah, totally agree with Benson there. I mean, there's been a lot of talks why there's no inflation over the past 10 years. There is inflation, it's on the assets. And I think you very much pointed out that there's a ever wider gap between the rich and the poor. So in the pandemic, somewhat accelerate a lot of that as well. I mean, if you look at, you know, all the billionaires that gained hundreds of billions over the pandemics. So, and I think that gap will only be widened. The sad thing, if COVID actually continues to be in that case, is the opportunities would be far and fewer. A lot of the things that normally make money would not, right? So things would just keep on continuing to push up. And then if the Fed pump more money, then things will continue to keep pushing up. We can debate forever if the US, if the Fed is currently obviously testing the limits of monetary, the new monetary policy. So we'll see where that ends. It might just all collapse at some point with USD falling But you don't know. So it's a long time, I think, at least we've been underwriting it. It'll be a while before we see that.
Yeah,
Michael?
good point,
Yeah.
Cam.
I also think that if we are having an environment with 5 more years with COVID or similar, then I agree with Benson. I mean, the one area I would bet on then would be technology, and also, so if you've probably all been in this situation, so or similar situation. So just to give an example, I sit on a board in a traditional industrial company called Lanapro. It's a Norwegian company. They have environmentally friendly greases, so no technology. It's a company I invested in 12, 13 years ago. Not a very good return, unfortunately, but I sit on the board there, and I've struggled for several years to just go have the meetings, board meetings on video conference, to use collaborative tools, so cut down time both for us board members but also the management of the company. I've been banging my head against the wall, trying to introduce these simple things like we take for granted here in this panel. But that's the reality out there. But come COVID, it took 2 weeks and we were all on these tech platforms. And,
Yeah.
And we're saving 50% of the time is my guesstimate. 50% saved. And they are enthusiastic, right? So wow, can we do this online? Can we, and that's 80% of the world. They're still, or before COVID, they were still there. And now they realize, wow, there's something called cloud computing. You have a software as a service, and you don't have to have your server in the office. It's actually safe to buy this service on the cloud. So this effect of COVID will just be exponential also going forward. I've said always to the companies I coach, founders and so on, and also of course my portfolio companies, that one of the biggest requirements I have for these early stage companies is show me a way to go to market strategy which isn't based on paying ads to get your product known, because we have so much information today. So there's just been a blockage. So I don't believe, generally speaking, I don't believe in regular advertisements. But now I think we have a much greater opportunity, we as a tech industry, to actually reach out and when we say that you can actually save 30% of your time and resources using this tool, you get attention more today than before COVID.
Yeah, I agree.
I think it looks like this panel is totally for technology, which is I think why the panel is here. So okay, I think we've only got 5 more minutes. Let's summarize and discuss. I think we're talking about a few things: e-commerce, fintech, with all is basically as part and parcel of a smart city or otherwise. And if the panel is of a different part of the world, and let's say if you're not in China or in Asia, so may some of the audiences come from different parts of the world, and the technology may not be advanced as what we see in this panel here. What would be your advice? Let's say if you have $10 now in your pocket, how many dollars would you put in tech, and how many dollars would you put in a more comfortable sector? Why start with Benson? Let's say you got $10 in your pocket now. How much would you put in tech, and how much would you put in other sector, or someone who is actually not familiar with tech?
Okay, great, Edmund. I like that. Basically, all 4 of us are saying 100% tech for us. Okay.
Yes.
Now,
sure.
I think for family office, they should do a very interesting exercise. look at your own portfolio and what is your technology exposure. I bet most of the people would have 5%, 10% maximum, probably very bullish already if you have 10% of your portfolio in technology, right? Now,
And that's only $1, yes.
Yeah, so my challenge to everybody is to say, whatever you have, you should double it. You have 1% only, please double it to 2. If you only have 5, double it to 10. Because even if you have 50, you should challenge yourself, why not 100? Because all 4 of us are saying max out. And I bet you most of the people listening in only have about 5, 10% in technology. And so the challenge is very good, which is, why not double it? And that debate for yourself, because remember, the actual dollar within 10 is a very personal decision. It's balancing risk and life, where you stage of life and all of that. So I have no answer for you, but I think anybody to challenge yourself and double your tech exposure, whether you decide to invest in tech ultimately or not, that's a good exercise to have. That's my answer.
Great. Michael, what do you think? $10 in your pocket. Tell us how you're going to spend it.
Yeah, so I would also, yeah, of course, I would put $10 into the tech sector. I would. I can't see any other sector that is the whirlwind in the stream here. So I think that's, but Benson's challenge, I really like that one, and I wish I could answer that. But I would put $10 into technology. But another exercise is, look at your traditional investments when you do that Benson exercise. Look and see the past years. What effect had technology on my investments, non-technology investments, and then you can, when considering how much you should allocate to tech, then you can consider that that's just the beginning of the disruption those other assets will have from tech. That will just continue to exponentially rise the disruption from startups in your other investments. So the risk in all the other investments will rise because the traditional industry players, they are not the ones that are going to disrupt themselves. So it will be external tech companies, startups that will spearhead these disruptions. That will just increase going down the line.
Great. Ken.
Yeah, I guess that leaves me last. I'm conflicted a little bit. I'll tell you what I have on my personal portfolio, which is going to contradict what I have to say. It's actually 8 to 2, $8 into tech, 2 into healthcare. But that's for a specific reason. So now I'm going to switch over to my family office hat as well, right? If you look at, if you put money into index funds, about 30% of that will go to tech naturally, 30, 40%, if not more at this point. I've stopped tracking. So your tech exposure, no matter what, is going to be high. If you put money into fixed income, especially in corporate bonds, it will go naturally to tech because that's where the AA, AAA++ ratings are. So no matter what, it's very difficult to avoid tech to begin with. Now, if you are talking about the make money pocket, which I'm assuming what this $10 is about, and that's how I tranche things, I would suggest that put money into it as much as you think that you understand in order to make money, because tech is a broad terms, right? Fintech in Africa is different from fintech in China, it's different from fintech in the US. Healthcare has its own world. E-commerce is also its own world with the market effects and all of the stuff. SaaS is another game. So pick your battle. And if you want to go more of an index approach, and that's what I do with my own personal money, because I don't have time to go and take a look at it, that's fine. I think you can go gangbuster on that. Primarily because tech today isn't the .com. It's not like tomorrow Google and Facebook and BAT are all going to miraculously explode, right? They are companies with good fundamentals. They do make money. So it's unlikely that that's not going to happen. But if you are truly looking at places where you want to make selective bets in an early stage or growth stage, or into funds or co-investments, that requires more delicate balance, but it should scale with your knowledge in the area. That's my 2 cents on it.
Yeah, I think there's a question from one of the audience that they need cash flow to survive, to pay the bills. I think the panel is not saying that you should not pay your bills. I think the panel is saying that you should focus 100% on tech, but I think that there's a portion of what are you comfortable with, and I think to learn from what you actually know or do not know, and then diversify your portfolio according to your comfort level. I think the panel down here is all for tech, but I think we also understand that you need cash flow to survive. So some of us may exit the investment early to have the cash flow. Otherwise, to excess cash which are not invested, you can put in something which is more liquid, which will give you an income. I don't know, probably that is, I speak for the panel off the cuff of my head. Our time is up. I shall pass the it back to Alex to continue the discussion or otherwise.
Well, thank you, Edmund, and nice meeting you, Mikhail and Champ.
Yep. Thank you, Benson. Thank you, Mikhail.
Yeah, nice meeting you, Mikhail, Benson, Champ.
Yep.
Thank you, Edmund. Thank you to all the panelists for providing your input on today's session.